Welcome back, everybody, to another episode of Take Back Control Tuesday. Now, I can't tell you what the outcome is going to be for each and every one of you, but what I can tell you is for the next hour and 40 minutes, the time we're going to spend together, if you apply what you learn, this will change your financial future. If you're here, that means you're ready for change. And tonight, that's exactly what we're gonna deliver. I've got a special guest for you. His name's Jason Sipple. He is a master of what you're gonna learn. But what are you going to learn? Well, Jason is gonna teach you three things. He's gonna teach you how to take back control of your money by being your own bank. And then he's also gonna teach you how to build wealth through your own debts and expenses. That'll be the second thing you learn. And the third thing you'll learn, hence the cars, you're gonna learn how to get all the money back for every single car that you ever buy, drive, and own. And before you get into it, one last favor, just click that button right there, the subscribe button. It would do me a huge favor. And also, right above is a little bell. Smash that bell so that every time I put new content out, you'll be notified. So I don't want to waste any more time. It's time for Jason to really show you all about the infinite banking concepts. Let's roll.
Take back control.
Tuesday night.
Tuesday?
What if by changing one thing, everything would be better financially for your family? How many of you would make that one change? Pop in the chat. How many of you want more money? That one paradigm shift and new skill set is the gap between you and the wealthiest families. It's the difference between being a borrower or a builder. Welcome and congratulations for being here today. High five your neighbor. I know we're virtual. Pretend a high five, pat yourself on the back. Many people could have been here today and they chose not to, but you showed up for yourself and those that you love. And that's awesome. In the next 6 hours, just kidding, I'm gonna let you in on a little known secret, a little known fact that the wealthiest families and visionaries like the Rockefellers and Walt Disney have been using a strategy called the infinite banking concept for ages to build and preserve their empires. The strategy is simple. It's legal, and it's something that each and every one of us has access to. And it all starts with changing one thing. Start loving yourself more. Start paying yourself first. Shockingly, we're giving away a big chunk of all of our money every time we get paid to the bank, the government, and Wall Street. We literally stand last in line for our money. And today, I'm going to show you how to take back control from them. How many of you would like to know how to take back control from the bank, Wall Street, and the government? And would it be okay if I shared a little about myself and why I'm so passionate about this? You know, why this means so much to me and my family? So I want you to imagine this. They're going to give you a job where you're going to work 30 extra hours a week. You're going to take on a ton of additional roles, stress, responsibilities, and bonus, here it is, you make zero extra money and have no equity in the company. How many of you would want to do that? Nobody. You'd have to be an idiot to do that. And yet, that was me. And it gets worse. I left that role when I had this realization, went out, built my own company, and within the first year, I found myself helping someone else during the pandemic build their coaching company from $0 to $4 million. And here I am making my same mistake because I didn't learn yet. And then I hit rock bottom. I'm standing in the back of the room as one of the leaders, leading a mastermind in Mahwah, New Jersey, of all places. And while the leader's bringing us through this exercise, what do you want to be when you grow up? How much money do you have? How many extra homes? All of the things, and everyone's getting excited and jumping up and being pumped up about what is possible. I broke down and started to cry, just standing there, tears running down my face. And I felt like I failed my family. In that moment, I felt like I had failed my boys, my wife, and I wasn't doing what I was meant to do for them. I was failing. I was working 18 hours a day. I'm living away from home. And after that day was over, I had to reflect and I realized that it was my rules around money. It was how I thought about money and entrepreneurship and just in general how money worked. And I realized I needed help. And when I got back to Orlando, the city beautiful, I went and asked one of my friends, got humble, all right? Got to put my ego aside, got humble and went and asked a friend for help. Well, my friend's a fiduciary with 40 wealth management offices. And I said, hey, man, I need a financial philosophy. I see that you're doing really well. Will you guide me? And he handed me a book. And I'll show you this book, but he handed me a book. And I went home and read it that day. It was a Tuesday. Don't be too impressed. It's only 91 pages long. So it's not like I'm super reader and it's huge font. And I got really mad. I read the book and I got really mad. I thought if this was true, every American would do this. And then I read the book again and I called him up and I cussed him out and I was like, B-Reps, what the bleep? Why didn't you tell me about this? And he said the most profound thing. He said, Sip, you weren't ready. And that became my mission. From that day forward, our family has used what I'm going to show you today, this infinite banking process, to take back control of our money, to turn our debts into assets, and now to have positive cash flow coming back in. By the end of our time together, you're going to know the secret the wealthy know, and you're going to know how to do it. You're going to know how the banks take your money and make tons of money for the money that you work so hard for. You're going to know how you can give yourself a raise by recapturing all the interest that's currently leaving your family, turning your debts into assets. And most importantly, we're going to show you how to guarantee generational legacy and the resourcefulness and the foundation on how to do that. You know, by the time we're through with this, you're going to have all the tools you need. How many of you will think that is going to be valuable? And you might be thinking, if you're new, you might be thinking, Jason, this is crazy. This is unattainable. But I promise you, it's really within your grasp. My only request is that you keep an open mind and understand that if you don't know something, you just don't know it yet. Because everything begins with the way we think and changing that one thing. So let's jump in. So R. Nelson Nash has this great quote, infinite banking begins with imagination, reason, logic, and prophecy. So if you're not driving, I want you to play along with me and do this little visualization. We're going to close our eyes and we're going to imagine that we're all back and we're new grads in high school. We're 17, 18 years old. There's 100 of us. And I'm going to ask a question. I'm going to say, hey, how many of us are going to be successful by the time we reach retirement age or passive income age? We're going to be jumping up out of our seats going, ooh, me, Jason, call me. I'm going to be the next Elon, the next Mark Zuckerberg, the next Warren Buffett. I'm going to be wildly successful, a millionaire, a billion. I'm going to have the first one-person billion-dollar company, right, with all the technology advances. You're going to be so excited. But then something happens. And hopefully you can open your eyes, by the way. But we're going to be so excited. And then something happens over the decades to come. It is slow, insidious, and almost imperceptible. But we all share the same feeling around money. And the number one feeling we have is fear. How is this possible? How is it possible during a short lifetime, we can go from thinking anything's possible to really feeling like we just can't get ahead? And especially living in the greatest country in the world, right? Just imagine this. We live in the greatest country in the greatest time, and somehow this statistic is still accurate. Only 5 out of 100 people, according to the Social Security Administration, will be financially secure, which doesn't mean wealthy. It just means secure by retirement age. Well, you guys are the 5%. You're the ones that are already here giving your time, your most valuable resource, your energy to learn what the wealthy are doing. So I know by just applying and changing this one thing, you can put yourself on a different path. You can get off the rat race and get the exit ramp to get right off. So let's jump into this. Let's talk about who else talks about this that you guys already know about. And first, we're going to point out this great quote by Will Rogers, just saying, hey, you know, the problem in America isn't so much what people don't know, it's what they think they know that just ain't so. Maybe you want to write that one down. So let's talk about some of these other folks who you guys already probably are aware of that talk about this concept. The first guy, he's got a rich dad, a poor dad. You've probably read his book, right? Robert Kiyosaki, but he talks about this concept in Second Chance. And then you got the big guy who changed my life a few years ago, you know, back in 2019, who really set me on this path. And Tony Robbins, Money Master of the Game, section 5.2. And then the book that I was mentioning that I keep by me at all times. This is the book that I highly recommend that anyone who's ever going to implement this or is implementing this reads this and reads it on a regular basis. This is your rule book showing your human nature and how the game's actually played, because without knowing the rules, how could you possibly win? So R. Nelson's Becoming Your Own Banker. Then you get my peers and partners, Brent Kessler, Chris Naugle, who wrote out Mapping Out the Millionaire Mystery, kind of their take, their journey on the infinite banking concept and how it's worked in their life and how you can make it work in yours. And then when you understand how the banks make money, Chris has this guide, the Private Money Guide, to show us how we can keep our money in motion. Now, I want to talk to you guys about an intriguing concept here. And I don't know if you're, like I said, if you're new here, if you haven't seen this, you can go to YouTube. It's riding the backwards bicycle. And it's a super intriguing concept. This welder decided to be funny to weld a neck on the bike that made the bike work differently. So I want you to think about who learns quickly and pop it in the chat or yell it out. Our kids, right? Our kids answer quickly or learn quickly. And think about when you learned how to ride a bike. If you know how to ride a bike, pop a 2 in the chat. I want to know who here can ride a bike or remembers riding a bike. But when you got on the bike the first time and you push down the pedals, what happens? The bike lurches forward. Whew. It starts moving. And when you turn the handlebars to the right, the bike goes right. When you turn the handlebars to the left, the bike goes left. And of course, you know, you're flying down the street and you think mom and dad are still running behind you. And then you realize that you're free and you fall down, you scrape up your hands and you scrape your elbows and you're crying. But what happens? Did you stop? Did you give up? No, you get back on the bike because kids are also resilient and they understand that, hey, it's going to take practice. So they keep riding their bike. And for me, that was my first freedom. It was such a game changer in my life. So what if it didn't work that way? What if your bike actually, when you turn the handlebars to the right, the bike went left? And when you turn the handlebars to the left, the bike went right? How many of you think you could ride this bike? I always raise my hand. I think I could. And my only request is you guys just hold your laughter when I hit the ground or when I wobble to a stop until you know I'm safe. And the reason this is so intriguing, because once our brains learn a certain neural pathway, it's like imagine you're skiing down the same slope year after year after year, and it just turns into this deep rut. Now, you know, skis, you know, if they're in a rut or they catch a rut, a lip, they're going to pull you in a different direction. So imagine trying to come out of that rut and going on a different path. It'd be pretty difficult. And so my challenge right here before we jump in to the rest of our exercises is just understand that what if money for your whole life works like this? And what if everything that we know about finances and money isn't the truth? It's a lot to take in, but just hold space that we're just going to change one thing with your financial life to make everything better. So let's jump into this. So just make a quick note here. It's going to be super quick, but catch this. What is your priority in the moment financially? Now, we all already raised our hands and said we want more money, right? So what is your priority in your financial life today? Not where it's going to be 10 years from now. I know you all want to be wealthy, have a guaranteed legacy, feel that peace, that feeling of freedom. You know, because money is not freedom. Some people might say that, and I'm going to ask that in the next slide. But where do you sit today? Do you want to eliminate debt, outside debt rapidly? Do you want to build wealth for purchases? Are you looking to put your little green men to work and have your money make money? Or are you looking for a tax-free wealth transfer to really leave your family and the things that you love and the causes you love better off than they are right now? Just make a note for yourself, write that down, even pop it in the chat. Pop it in the chat. And the more you guys share, the more you guys support each other, the stronger this is going to be, because this is a special group that we have here today. And why aren't more people successful with money? You know, money in my mind has two parts. It's the math and the mindset. I love the mindset because I think everything begins with our decision, our belief, and then it eventually becomes a habit, becomes a pattern, becomes our values, becomes our standards, becomes our life, our destiny, right? And so what are some of the wealth killers? You know, anyone here not pay enough in taxes? Anybody? You want to pay more in taxes? No, right? Nobody here is looking to pay more in taxes. Does anyone think that the inflation is going to go up, down over time, right? Inflation's another wealth killer. Market volatility. The market's going up, it's going down, it's going up, it's going down. Tariffs, no tariffs, tariffs, no tariffs. The interest, the money that's leaving our family. If anyone wants to give themselves a 35% raise, just by changing where the interest is going, you will accomplish that. These are some of the biggest wealth killers. Now, on the mindset side, it's following the status quo. I call this being a sheeple, just going along with what everybody else is doing. Oh, grandma told me that, or my broke ass brother-in-law told me that, just following everybody else. And then fear. And the fears in life are, there's two of them: fear of failure, fear of rejection. And neither are true. No one can reject you except you, and you cannot fail until you go and graduate. So there is no fear, but we all feel that, just how we are wired. And our distractions. There's so many distractions today. There's so many things that keep us occupied. Our phones, you know, being able to binge watch shows, whatever it might be, social media, so distractions. And what we're taught. If you have a financial education, pop in the chat, put finance. You know, I'd love to know or share. And how were you taught? When were you taught? My belief is that we were all groomed to give up our control. Like, there's two different games that we're all playing. Here's the wealthy's game and here's our game. They're going in exact opposite directions. What's really happening is our game, right, is feeding the wealthy's game. Like, where we put our money, someone's making money on our money, and that's the wealthy. And they have set up this system, but we can play by these same rules if we learn. So let's talk about some of the mysteries of money. Let's start with a simple question. What is the definition of money? Now, how would you define money? Money is blank. I was at a mastermind all weekend and we talked about this endlessly. Money is what? My answer is a means of exchange. I think that's the simplest way, right? It doesn't have meaning. It's not freedom, because when we're beholden, if money is freedom, that means we're slaves to money and vice versa and all the things. But money is nothing more than a means of exchange. It's energy, and it has to be in motion, right? Money to make money has to be in motion, like anything. It's natural law. Think about it. You would not drink from a stale pond, right? Water or fish from a stale pond that doesn't have any movement, water movement. Our bodies, if we don't move them, they're not healthy, because the blood has to flow. Our muscles have to work. Our systems have to work. We need to move. That's why we go on walks. That's why we lift. That's why we do all the things. Now, pop in the chat, what company uses compound interest? Some of you might have said, oh, calling me, banks, Jason. I say, yes, but not really. Think about it. When you get paid and you go into a bank and you say you have a $100 bill and you're depositing, if you wrote your name on it, like you wrote, Christian O'Mara or Steve Holcomb on the $100 bill, and does the teller take your money, walk back there, deposit in the box, and it just sits there? So when next time you go there and get the money, they hand you back the same $100 bill? No. As soon as you deposit your money in the bank, it's a liability and the bank has to move your money. So there is no company that actually uses compound interest. Are your dollars worth more today or in the future? This one can be confusing, but think about this. If you had $1 20 years ago, how many candy bars could you buy? A few, right? You can buy more than one. Well, today you can't even buy a part of a candy bar. You can maybe buy a third of a candy bar for $1. So our dollars are always worth more today than they will be tomorrow. Okay. Taxes. You guys think they're going up or down in the future? Up or down? Pop in the chat, up or down. We're going up hundreds of billions of dollars of debt per day, trillions of dollars per year. So definitely, if they don't go up, they're going to tax us on more things. It's the only way the government makes money. And now, what do you guys know about your retirement account? Like, if you are contributing, that's awesome. That means you're paying yourself, you're paying your future self. So congratulations there. But I wanted you to think, when you're entering and paying into a retirement plan, whether it's a 401k, whether it's a 403b, or whatever your company sponsored plan is, you have a partner. And I want you to imagine you're going in a partnership with your best friend. And now your best friend, you love them, they're awesome, right? Your best friend's like, cool, I'll be your partner, but let's talk about our partnership. What does it look like? I'm going to be the best partner for you because I'm never going to bug you. I'm going to let you run the company. I'm going to let you take your little seed and grow it into a great big harvest. And you're never going to hear from me unless you need to access the money early, unless you need to make certain changes or withdrawals. There's going to be certain stipulations. But for the most part, I'm not going to bug you. As long as you just leave it in for the long haul, you're going to be cool. Cool? And then when you reach the time where you're ready to use that income, right, to retire, to go on trips, to do whatever you want to do with it, your partner, your best friend is going to say, hey, I know you've been working really hard for this. High five. You did awesome. Now I'm going to need my 34% or 28%. Whatever your partner tells you, you have to pay them. How many of you would enter that partnership? How many? Nobody, right? You'd have to be crazy to do that partnership. But yet, that's what we're doing because we're not stopping to think about what's really happening. That is what's happening in our qualified plans. So you guys have been wondering the whole time. I told you I'd keep this stupid simple with simple. The money multiplier method, right? Mapping out the millionaire mystery. That's what I promised to show you guys today. So it's going to be 3 parts. It's going to be the machine or the engine, right? The vehicle. Then it's going to be the marathon. And you saw earlier, I only run as if I've swam and biked, or if I'm training to do, an Ironman. But this is not a get rich quick scheme. So if anybody thinks that, you're definitely in the wrong place. This is over the long haul. It's our first principle. And then we're going to show you how to map out the millionaire mystery, because the fact is, Americans, we make more than about every country in the world collectively. We're just really bad at keeping our money. And so I want to show you how, by taking back control and changing that one thing, that you're going to be able to map out the millionaire mystery with doing nothing more than just changing where your money goes first. How many of you like that? Right? So let's talk about this machine. What is this magical machine, Jason? Well, it's kind of boring. I'm trying to make it sexy and fun, but it's nothing more than a dividend-paying whole life policy from a mutually owned company. And caveat, a company that's been profitable for 100+ years consecutively, never had a year when they weren't profitable. They're the only kind of partners we're looking for. And what is it not? It is not any ULs. It's not IULs, VULs, ULs. It's nothing that's going to transfer the risk back to you. And in this case, it's not term either, even though they all have their place, especially term. It can provide us with that peace of mind or coverage we might need, or maybe a convertible term is even a step up. But that's not what we're talking about. We're talking about whole life insurance from a mutually owned dividend paying company that's been specially engineered for you and what you're trying to build in your life. Remember, this is all about your journey. Now, as long as you're not driving, grab a pen, grab a paper, a crayon, something to write on. And we're going to do a quick, fun, interactive exercise. So you're going to draw a T-chart like that. Top left, you're going to write bank. Top right, you're going to write policy. And underneath both, you're going to write the word liquid or liquidity. Now, I want you to pop it in the chat. What is your definition of liquidity? And then share yours, and I will tell you mine here in a moment. So what do you guys think? What is your definition of liquid? Okay, so I'm gonna imagine that you just popped in the chat that liquid is just having access to the money. Easy access. There we go. We just saw it there. So for me, liquidity, mine's a little cheekier. Mine just means it's not locked up in financial prison, right? Your partner doesn't have a hold of the money that you can't use because why? It's your money, not theirs. Now, if anybody has a high yield savings account, pop that in the chat. Put your actual number. I talked to a guy earlier today that had a 4.3%. That's the best one I've heard in a little while now because they've been going down, down, down. I don't know if he really knew it was 4.3%, but it was one on the online one. So 4%, 4.25%. Liquid margaritas. I like that. Anthony, you definitely are an Eagles fan. So we got 0.07%. Let's write 3.25% and make a note. G1. That's your first guarantee of 2 guarantees. That's one of the reasons we like to joke around. No one's really mad at us. We do what we say we're going to do. Right? All we're doing is helping you do what we're doing. So write 3.25% down as guarantee number 1. Because under the bank, you folks with the 4%, 4.25%, with the awesome high yield savings accounts, all of that's taxable. And you know this. You see your money growing little by little, and then it's all going to be taxable growth. On the policy side, it's tax-free growth, tax-free loans, tax-free growth, tax-free distribution. On the bank side, we have unstable. Jason, what do you mean by unstable? Help us understand. Okay, unstable, I just think back to Silicon Valley Bank beginning of 2023. You guys remember what happened, right? Almost everybody I ask, even if they don't like finances, remembers that that was a huge deal and all over the news. $204 billion failure or $1 million failure, right? And why did they fail? Well, they failed because of the fractional banking system we have. And Signature Bank failed over a little over 100 million. And how did they fail? Well, it was because when you deposit $1,000 into the bank, they only have to keep 10%, $100. They move to other 900 and they turn your 1,000 into 10,000. It's what causes inflation. This kind of banking, our regular banking, is inflationary. It's unstable. On the policy side, you have stability. Again, all 5 of the mutually owned dividend paying companies that we partner with, right, that we have partnerships with, because remember, we're looking to help you become a partner there, have been profitable every single year. And the example we're using here is every year since 1877. Wow, that is a long time ago. Pretty dynamic, right? You guys find that to be a little bit more stable. And why is it stable, Jason? Because, great question, they practice Austrian economics, which means that a dollar must be backed by a dollar. So your cash value, borrow from it, your back dollars backed by a dollar. And then one more, under bank, it's unprotected. If someone gets hurt on your property, you're an entrepreneur, maybe you're a driver, whatever your way of making money is, if something happens and you have money in a savings, well, a good attorney can get at that money through liens and judgment. Whereas the policy side, it's protected against liens and judgment. Now, it's different for every state, but it's always more protected than it is in the bank. So far, on the policy side, the living benefits, right? Just make note of that. Living benefits, we have guaranteed, tax-free, protected growth in a stable environment away from the government where we have access to the money. And now the last one under bank is there's no death benefit. If you have a bunch of money in the bank, you draw it down, what happens? You go back to that zero line. Where in the policy, this is your guarantee number 2. You know, as fathers providing, protecting, procreating, who says you can't buy your legacy? Your legacy is a resourcefulness you pay on, but as far as financial means, we can instantly leave our families in a better place because now you have a tax-free estate that's free from probate. That's your second guarantee. So now looking at these charts, imagine we called in your kid or your grandkid, 5, 6-year-old, and we brought them into the room. We said, hey, you know, we're going to put you on the board of directors of this giant bank. And the question is, where should the banks keep their money that has to be safe, protected, and guaranteed to grow? Are we going to put it on the bank side of our ledger or on the policy side? Now, As silly as that seems, the 5 or 6-year-old could look at that chart and be like, hey, Jason, it's all green on the one side and all red on the other side. Let's go with the policy side. And the reason I ask this, the reason I'm showing you guys this, and the reason I had you write it down is because you can hang this on your fridge. The banks have quadrupled the amount of specially engineered whole life that they've purchased since 2012. That's 4x. They own currently over $225 billion of this stuff as of Q2 of last year. And when I started teaching this, it was 180, and then it went to 200, and it's 225. And I don't know how much more growth, but I imagine they're probably closer to 230, 40, 250. And why do they do that? This is why they know that their money is protected, it's guaranteed to grow, and if their employee passes away, guess what? The bank just gets more money, more tax-free money.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
One of the biggest questions I get all the time from you guys is, well, Jason, I get this. This makes a lot of sense, but it seems really complicated. And a lot of the questions are around, how do the premium deposits work? How does the cash value loans work? And how does the death benefit work? So I'm going to take the next 3 or 4 minutes to just walk you through what it looks like visually, so you guys understand that in this 3-cup setup, this is just really how your banking system works from a super simple point of view. Would that be helpful? So let's imagine in the next example, when we get to turning your debts into assets and we get into making your major purchases, we're going to make a deposit, and this person's depositing $10,000 annually into their premium deposit. That's paying themselves first. Now, instantly, that's going to buy something. And what's it going to buy? Well, it's going to buy a death benefit, and it's going to buy a multiple death benefit. And as soon as that happens, what's the next thing that's available? Well, immediately, you're going to have cash value available or a loan available. Now, the first cup is a guaranteed cup on that T chart. The third cup is the second guarantee. And this middle cup is the general fund of the insurance company. So remember how I was doing this with my hands? So now you made the premium deposit, and now you're taking a loan against your cash value ledger. You're never taking money out of the policy, and that's why it's tax-free. So now you've taken $1 or $10,000 and you've given it 3 jobs. You are saving it where it's growing guaranteed and tax-free. You are using other people's money with cup 2, and you have a guaranteed death benefit. You've just given $1, 3 jobs. How many of you, show of hands or put an I in the chat, want to give $1, 3 jobs? It's already a more dynamic way to use your money, right? So we're saving, we're spending, thank you, Kathleen, and we're protecting all simultaneously with multiple guarantees. Now, this is never guaranteed, but again, all of the companies we use have never missed paying a dividend. So at the end of the year, you get a dividend. That shot glass right there, that change glass, pours a dividend back in. So it adds to your additional 3.25, goes up to 5 or 6%. And what happens? What does a dividend do? It buys more paid up additions, which gives you instantly more death benefit. So now you have more death benefit, and it's going to give you more cash value, and it's going to give you a better chance to have more dividends. So by just working the system and paying yourself first, you've already given your money 3 jobs. So let's talk about how your money flows. This is going to be fun for some of you. For others, not as much fun. But we're going to talk about, I'm going to become Jason the banker now. Instead of Jason the money mentor, Jason the wealth strategist, I am now Jason, the actual owner of a bank or employee of a bank. And you, let's pick a name out, Frenchie, have been saving for a car. And you have really good saving habits. You have discipline. You're paying yourself first, and you're just storing it in someone else's banking system. And so you've been saving this $25,000 for a few years, and now you've had the car picked out. You have your interior picked out. You can smell that new car smell. You can feel that new car acceleration and you're excited. You see a new color, you feel good riding around in your new car, Frenchie, and you have this all picked out. And so you come in, and remember, whether this is $25,000 because you're getting a Ford Focus, or just add a zero if you want a Ferrari. That's for the folks sitting there thinking, hey, I spend $100,000, $200,000 on my vehicles. Some of you are out there, but you come to banker Jason, you say, hey, I need my money now. I high five you and I say, Frenchie, awesome job. I see how hard you're working or been working, how disciplined you've been, but I've got an idea. I'm going to give you or keep giving you 4%, but I'm going to give you a loan. And I'm going to give you a loan at 6%. And at the end of 5 years, right, 60 months, you will still make money. How many of you think that Jason, me, is an honest banker? How many of you think Jason's an honest banker or telling you the truth? Most of you might say, Jason, that's 4 minus 6. That's a -2. That's the first thing I said. This one right here took me 19 times to get, by the way. See, Frenchie says, no, I'm not telling the truth. But let's look at the math, because the math isn't going to lie to us, right? So let's take a future value calculator, and we're going to do the payments on the vehicle is $28,999. So we're paying $3,990 to interest to the bank over that period of time. Make sense? $25,000 car, 6%. Now, the growth on 25,000 at 4% over those 60 months is actually 30,525. Now, I don't know if you guys do math like I do here in Florida. I know we got people from all over the country, but $30,000 is more than $29,000 where I'm from. So Frenchie has made money, $1,526 to be exact. So I want you to, the exercise here was just to show you that the way that we're taught to think about money and percentages and interest rates isn't really telling us the whole story. We have to understand what's actually happening. In the account where it was growing at 4%, it was uninterrupted and compounding interest over time. In the other account, you're paying a decreasing balance over time. And so that's how you come out ahead. So we got to look at what is happening, because we're really talking about cash, right? And cash value. Now, since Frenchie, we did such a good job making you $1,500 and change, now you really trust me. So now as you're making money, you're depositing all your money into the same bank, into a regular old bank. And I already shared before, when we place our money in a bank, is it a liability or an asset? Look at Frank. Frank said, banks suck. Frank, I'm going to offer you a new perspective. What if banks are some of the best money-making machines in the world, and we have the opportunity to model them? So Frank, I want you to stick Frank's bank in the middle here. So now Frenchie's deposited $100,000. I'm paying them 4%, Frenchie 4%. I have to move the money, so I'm going to lend it to someone buying a home. Now the seller is going to bring the money and deposit it where? Back to the bank. Now money's back in the bank. Do I hold on to it or do I move it again? I'm going to move it because that blue house needs a blue Beamer. So now I'm charging 8%. And now we're going to put a pool in. So now we're going to do a home remodel, renovation. And we're going to do that at 9%. The money comes back in. And then when you buy a new home or move into a new home, there's so many things that you need for the home. And so there's no way that you could pay for it all. So now you do what? You open a bunch of credit cards. And now you're doing debt consolidation because you realize that the rates averaging 24.5% is crazy. And so now where Frenchie was making 4%, look at what the banks made. Let's figure this out together. 7 minus 4 is 3. 8 minus 4 is 4. 9 minus 4 is 5. And 12 minus 4 is 8. And so if we add those up, it's 20. Minus 4 is, did we make 16% more than the bank? Or did the bank make 16% more than us? No, right? They made 500%. There you go. Steve's got it. 500%. Look at that. So how many people here want to make 400 to 1,300% on every dollar they make, like the banks are making? Now, it's going to take time. This isn't going to happen overnight. But if you know it's possible by keeping your money in motion and building a foundation, Why wouldn't you want to do that, right? So now we're going to talk about, anyone here how many of you here want a 35% raise and will be pretty excited about a 35% raise? Anybody? There we go. Bunch of 35% raisers. So just keep this in mind as we go through this. This has been the truth and the way Americans spend money since the 1960s. And after 3,000 plus calls, I can tell you that people spend way more than 20 cents of every dollar in their automobiles. The next 30 cents of every dollar in housing, 40 cents on everything else. And finally, we're going to say that we're saving 10%. Now, does anyone know what our savings as Americans was last month? If you guessed less than 5%, you nailed it, right? It's 3.9%. 3.9%. So let's look at how much interest for each of these things that we're paying to the banks. So 5 cents of every dollar goes to the banks in interest. So we finance everything we buy. Write this down. We earn interest, pay interest, or when we pay cash, we give up the opportunity to earn interest. That's super important to the foundational principles and teachings I'm sharing today. So we got 20 cents of every dollar to automobiles, and 5 cents of that is going towards interest. So now we're going to take back control of that, which I'll show you how later. Just imagine this is money coming back to your family now. And now with homes, if you've purchased a home or you've been in your home for 5 to 7 years, pop in the chat how long you've been in your home. We've been in this home 7.5 years, almost 8 years now. And when you don't do this, because you won't like me, because I didn't tell you to do this. And by the way, please don't believe anything I'm telling you. I should have gave that disclaimer earlier in the day. But when you go look at your statement for your house, you're going to see that you give away 70 to 80% towards interest if it's within that first 7 years. And the banks know this. They know we get bored and move every 5 to 7 years. So now we've put 30 cents per dollar back in our pocket. Everything else, another 5 cents. So now our savings, rather than being 10 cents of every dollar, has gone up by another 35 cents. And now we're saving 45% of our income in interest has come back to us. Do you guys see? How many of you think that's a powerful concept right there? Like if I started right there, you guys would already have a much better place to start from. So let's talk about a better way to purchase vehicles. And this is when I'm going to pick up the hood. We're going to dive into the machine and I'm going to show you something that's pretty profound. And we're going to talk about your premiums as premium deposits, because you're doing what? You're depositing in your banking system. We're not going to worry about the age. I have a whole nother training on that shows you whether you're 21, 31, 41, 51, 61, or 71, as long as you have good health, then your age is not going to matter when it comes to this equation. And we're not really going to talk about the legacy piece, the second guarantee either. And so now we're going to use Frenchie again because I had good saving habits. And you're going to keep making that $10,000 a year deposit into your system. After 3 years, the car's been, messed up. It's been driven a lot. People have spilled things. Kids have dropped food. It's time to get that new car smell again. And so you make the deposits over 3 years. Now you're going to take a loan for $25,000. And since it's our system, we want to treat it with some respect, right? We want to treat it as an honest banker. We don't just want to take the money, walk out the back door, and steal the peas, as Nelson would say. There you go. I couldn't remember if I popped my info in the chat, so that's in there now. And so now you're going to pay yourself back, just like we did in the other example, except we're going to round it up to $500 a month. You're going to put $30,000 or $6,000 a year back into your account. Now, over that first 7 years, you've deposited $70,000. You've made car payments back to yourself of $30,000, and you've taken a $25,000 tax-free loan. You have $75,000 left, right? That's 91 cents of every dollar is back in your hands, and you have a new vehicle. So now it's been 5 more years. Car's a little beat up again, and now it's time to make another car purchase. But we're going to do something crazy. In year 8, we're not going to make any more premium deposits. I would never teach you to do this because at this point, it's so efficient that every dollar you're putting in is giving you more than $1. But we're going to just do this for illustrative purposes. You're going to pay back the same amount. You bought the same vehicle. So now at the end of another 5 years, all you put in is the car payments back to yourself, the interest back to yourself. You made a $25,000 loan, but your money has grown by $23,592. How's that possible? Well, because your money keeps growing. Now you have 2 vehicles and you've actually made money buying the second vehicle. Has anyone ever had the vehicle and all the money or more than all the money back after they've used the vehicle for 5 years? Anybody? We're almost there with our 2 vehicles of recapturing all of that money. So I'm going to go over 3 quick rules with you. The first rule is the one we've been talking about the whole time. Loving ourselves more, paying ourselves first, doing it as if our life depends on it, because it does. Number 2 is paying yourself with interest. This is just being an honest banker. And recycling and recapturing the money means that you keep making the deposits and you're paying yourself back. Now you've kept all the interest and the money keeps flowing, right? The money you used to buy the first car, you've paid it back to yourself and you use it to buy the next car, and you're recycling, you're recapturing, you're moving the money. And all this begins by just changing that one thing. So if this works for a car or a truck, what else does it work for? Everything, right? Anything you can imagine. That's why it's called infinite banking, because you can do all of these different things with it. So now we're going to go through one more example. Now, this example was after someone, it was actually one of our clients, a chiropractor, sat and listened to this presentation, our version of this presentation, saw the examples, and they came up afterwards and they sat down and they asked Chris Naugle, "Hey, Chris, can you help me?" What do you think Chris's answer was? He said, "It depends, Mr. Chiropractor. Show me what you're working with. Show me what you're doing." And so this was the guy's scenario. He's 40, I think he was mid 40s, healthy, 45 years old, healthy, had $478,774 in debt. If he just kept paying all of these credit cards, the mortgage, the condo, the boat loan, all these things, it would take him 19 years. So Chris asked him, "Well, how much are you saving or how much are you putting aside?" He said, "Well, I'm putting $25,000 a year into a qualified plan." And Chris just asked, "Are you willing to move where that's going? Are you willing to put it into your specially engineered process, and we'll help you cut this down and pay off this debt much, much faster and keep a lot of the interest that you would have paid to the bank of or the family of Wells Fargo and Lowe's, Nordstrom, and all these other families, not your family, Doc." And so Doc said, "Sure." So let's see what happens. Let's go through this line by line. So in year 1, he deposits $25,000 into his banking system. Immediately within the first 30 days, he takes a loan for a little over $14,000. What do you do with that money? It's not new money to go spend, right? So he pays off Discover, pays off Lowe's, and he recaptures $448 a month. Already, money that was leaving his family has completed the circle and come back. Year 2, now it's a little monotonous, so stick with me for all you who don't love walls and numbers. In year 2, you got 25,000, and look, it goes up, the availability, right? Take out a little bit more. He's kept paying himself back that 400 and change per month. Now he's got 21,000 in cash, and he's going to pay off the next 3 debts and pay down the BMW. Year 3, same deposit, and something really cool happens. You're already at an efficiency point, meaning that every dollar that went into this is giving him more than $1. And he's made the payments back. That $19.17 a month is $23,000 and change. Remember how I asked you guys if you want a 35% raise? Watch what this doc does. Now he recaptures, he's up to almost $4,000 a month back to his family that was leaving. And so far, we're only in 3 years. Remember, this is a marathon. So far, how much have we put in? We put in $75,000 so far. We've taken tax-free loans on $55,000. What's the difference between those? 75 minus 55 is what? 20, right? Does he have 20,000 left in the policy? No. All $75,000 is left, and all of the cash value is earning uninterrupted compounding interest. How many of you would like to have a system like that? And now in year 4, makes the same deposit. The value goes up a little bit. He's made the payments back to himself. Now you've got $70,000, right, in cash value. You pay off the condo or down the condo. Year 5, same thing. Now the condo's paid off. 5 years, you paid off everything, and the only thing left is the house. Now let's look at year 6. Year 6, something interesting happens. You can't fit anything more into a specially engineered policy. It's at its limit, right? Here, this is an 8-ounce cup. Can you fit 12 ounces of water into this 8-ounce cup? If you said yes, you should just log out now. I can't help you, but most of you know that you can't. And so at this point, this doc, this chiropractor can't fit anything else in the policy. So he puts his $10,000 in. It gives him $13,000 and change. He takes additional money. He expands his system, his warehouse of wealth, and starts a second policy. And now between the payments back, the cash value loans, he's got $82,000. So it's taken him not 19 years, but how many years to recapture almost $6,000 a month? That's got to be exciting. And if you want to see the math, if you're an engineer or you're like, some of my peers who are really good in the spreadsheets, good in the sheets, as we like to joke around with them, we've added this new tool that you get to see when you go through underwriting after you've done your paramedical, and it's free, no charge. But what it's going to do, it's going to show you how long it'll take and what's the most efficient way to pay off your debt, whether it's snowball, whether it's avalanche, whether it's high interest first. And it's going to show you that you can recapture a ton of interest, keep more money in your family, get out of debt way faster, and have that protection piece and how long it'll take to pay yourself back. How many of you would think that'd be valuable to see before you even put your policy in force? Because now you have essentially a map to get to where we promised you can go, right? As long as you do the work. So we're coming to an end here. I want to know, how do you eat an elephant? Pop it in the chat. Jason, it's one bite at a time. As my wife said, Jason, don't start with the ears. Start with the feet. Maybe we'll make elephant stew and steaks and salad. You got to keep the elephant on ice so it doesn't go bad. We want to make sure we use all of it so we don't go to waste. But we're going to try eating it a lot of different ways. And it's very similar to the question, the man or the woman at the top of the mountain didn't fall there. They had to do what? They had to climb the mountain step by step by step. And by the way, no elephants were hurt during this filming. I promise. We love elephants. We're not harming any elephants. So remember how I said that we're going to map out the millionaire mystery? Well, if we kept paying back the homes, just like we were already paying them, but paid it to ourselves, look what happens. For the condo and the house, there was a bunch of years left, and we kept paying that money back. And look, if we just did what we were already doing, this doc didn't work any harder, any longer, or take on any additional risk, right? But now that's $500,000. But it gets better. You add the guaranteed interest rate that he's earning plus the dividend, and we're being super conservative at 4%. It's probably a little bit more than that the money's growing at. And now you got $750,000. You're well on your way to mapping out that millionaire mystery. So now that you guys know this, shouldn't everybody do it? If you're not doing it, aren't you stealing from your kids, your grandkids, and anyone else that's in your circle if you're not applying this? And as our buddy Warren said, who's sitting on the way, by the way, over $300 billion in cash right now, if poor people would just do what rich people do, they would not be poor anymore. That's powerful. I'm not even sure Warren said it, but I love it too much to take it out of this presentation. And so now that we're here, what have we learned together today? We have learned how the banks are making 400 to 1,300% on our money, on your money. And that's just nuts. How many of you would like to make that kind of return on your own money? We showed you how you can turn your debts into assets, a better way to finance things while keeping control of your money and protecting your family. And that's the power of becoming your own banker. And you know what the most common thing that's said to me by all of my clients, the 3,000 plus people that I've talked to? Jason, I wish I would have known about this 20 years ago. I wish I would have known about this 20 years ago. And here's the crazy thing about that. Do you know who knows about this and has practiced this? I told you right at the beginning. Rich people. And I guess they just didn't let the rest of us into the circle. Well, ladies and gentlemen, welcome aboard. You now know how the wealthy build their foundation and how you can do the same. And I got some bad news for you. Only one of two things is going to happen to us. And I'm sorry to tell you this. I feel kind of bad telling you this on a Tuesday, but at some point you're going to graduate, as my kinder peers say. I'm just going to tell you, you're going to die. We're either going to live, or we're going to die. My question, simple question, are you better off with or without this? Because now you know what the wealthy have been doing for thousands of years to build generational wealth and keep legacy, create legacy. Thousands of people have been where you are right now, right in this moment, and they have to make a choice. You're either going to book your strategy call with me and take action, have a conversation around your money, and understand how this can fit your life. And not one person I've worked with, and a lot of you guys are here in this chat right now, have been disappointed by having that conversation, taking back control of your money, and implementing the system. So if you're worried, stressed, frustrated, I know I can help. Again, I've helped thousands of people take back their control. So go ahead, scan my QR code, have a conversation with me. And if you don't, I still love you. And I'm so blessed that you've given me your most powerful resource, your most important, valuable resource, your time, your energy, your focus. So God bless you and be wealthy.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.